Okay, welcome everybody to another episode of Ridiculous. And let's just get the screen going here. There we go. All right, so we are continuing from yesterday our work on the Good Times restaurant. So the key issues we've identified so far. Other restaurant operating expenses around the premium price and volume business persist. And then yeah, that would be those are the sort of the key issues so far. We are here we go. Okay. So first things first is really we'll deal with the important stuff, or what we think is important stuff, which is really the growth in the business. If the business is going to get hurt by continued declines in revenue and profits, or at least margins that could get squeezed by inflation, then, and what we're looking for right now, so let's just back up. What we're trying to do is kill this idea as fast as possible. The thing step back again. Non-investment advice, entertainment and education. Follow along. We can make mistakes. We could be wrong. And all the tools we are using are free. So you'll see us use Yahoo Finance. We go to basically any tools that we use, we're trying to keep it all free tools so that anyone following along, whatever their skill level or whatever their capacity, can actually sort of participate or do the same thing we are trying to do. And really, it's the skill level you bring to the table, the interest and energy that you bring, that's going to help determine your results. So, with that being said, yeah, mostly today what we're going to be doing is just try to reading through some results and seeing, has management given, can we sort of identify anything that would prevent or be a hedge or mitigate the decline in pricing, right? Because that's or the decline in margin. Inflation is still rising. Management has said volumes are going down. Customers are engaging in check management, quote unquote, a phrase which we've now starting to like. So essentially, customers are buying maybe cheaper menu items. They're still going out, but they're buying cheaper menu items, and they're even going out just less. And that's all consistent with a softer consumer, which you're seeing in various parts. Obviously, interest rates have risen dramatically, and pandemic era savings have been largely burned off and are continuing to do so. So the combination of people have run through a lot of pandemic era savings, as well as people are or have been exposed to rising rates. That combination of those two forces is eventually going to cause, by extension, the consumer to slow down, because either consumers are leveraged, mortgages, car payments, whatever, and the business they work for are leveraged. So, you're going to see businesses, they'll be stingier on pay raises and bonus and profit share and all that. So it really just comes down to whether or not, uh, what are the chances that Bad Daddy's Burger Bar, which is primarily located in Colorado, as well as their other brand, um, can Colorado, or the economics in Colorado, be strong enough? And then the other side of that is, if it's not, what are the downside protections? And for this business, the balance sheet is good, but it's not going to be able to withstand, an infinite amount of financial stress, right? $3-4 million bucks cash is that June. We suspect at some point the company's going to release their next quarter. And let's see if there's any press releases. Yeah, so right. They bought back a Good Times location. Yeah, so, and here's fourth quarter same store sales. So that's just same store sales for the fourth quarter, but it's not the actual quarterly report. But what we saw is that same store sales increased 2.4% for Good Times and decreased 4.9% for Bad Daddy's. As a reminder, Good Times is the more fast food service business. So these guys would be an expensive, very expensive sort of quick service restaurant. Again, we looked at these guys and they're selling a double cheeseburger for $7. McDonald's is selling it for $4, just to compare the two. And Bad Daddy's is the premium burger brand. So they're selling burgers for $12, $14, $15, $16. The average check of Bad Daddy's is $36. So that's sort of the super premium, and it's also the one that drives most of the business. And they've seen consistent declines despite increasing menu prices. So same store sales decline for Bad Daddy's, and that's means that the overall same store sales they have a relatively stable store count over the last 2-3 years. So you're basically going to receive the full brunt of that as the business. Yeah, for the year ended, same store sales increased 3.7%, and for Good Times and Bad Daddy's, and for Bad Daddy's it was flat. So they for most of the year, it seems like they've been okay. Bad Daddy's is flat, but clearly into the third quarter, which they described, and the fourth quarter, it's about a 4 or 5% decline in same store sales. So we'll have to wait and see. I'm pretty surprised that they don't have a more recent filing, but because it's a September year end and we're already in November, but it's a small business, so it's not terribly surprising. Plus, last year, you can see here, they filed middle of December their annual. So, it actually takes a while for these companies to get their numbers out for a smaller business. Okay. Back to the topic at hand. So what we're going to do is now just sort of be reading through the most recent quarter to see if we can gain any insights around either brand. Are there compensating factor or factors that can compensate for challenges to the income statement? What would is there a way we can sort of say, okay, predictable decline? Because keep in mind, there's this business, again, one thing that we really like is that during the pandemic, 2020, when restaurants were closed, this business revenue was flat. No additional stores built out. Revenue stable. In fact, they shut down two of their stores, and revenue was basically flat during the pandemic. So that stands out to us as something that says, okay, the customer really enjoys these brands, and they've been around for 10 years, 10 or 15 years. So it's not like it's a flash in the pan, right? Like this is an established brand in the market. Customers clearly enjoy the product and the experience. And even during the pandemic, this is where customers were going to spend their dollars. So we think it's telling also too that if you can survive the pandemic without a material decline, that basically any decline in sales, and yet now you're seeing sort of a 4 or 5% decline year over year, or at least in the last few months. That's sort of telling, right? Okay. So anyways, we'll just keep going and read through. They have one partnership where they're the general partner and 5 limited LLCs. So maybe consider when there's think of the structure. This is kind of amusing. In the opinion of this is the quarterly, so it's not audited, but in the opinion of management, the company unaudited contain all the normal recurring adjustments necessary to present fairly the financial position of the company as of June and results of its operation cash flow. Well, of course management would have that opinion. That's their financial statements. It gives the air of authority, though. That's amusing. Franchisees contributed about 200 grand to their advertising fund. All right, how much? I'd like to keep a second window open just with the financials to see if we can pick apart any of the line items. So their advertising costs. Okay, this is good. So 200 grand for the 3 quarters, so year to date. Year to date advertising costs 2.4 million. So basically franchisees support about 10% of the advertising cost. The rest comes from the company itself, i.e. shareholders. Receivables look pretty standard, pretty plain vanilla. It's receivables from rebates and delivery partners. So basically, you're buying food, you get a rebate from your supplier. That's what we would expect. Large box retail partners get receivables. So, and franchise another. Yeah. So it's pretty plain vanilla stuff. Nothing crazy. Oh yeah, it's definitely important to read the accounting policies. It's dry, we get it, but consider you are using the financial information to make analysis and judgments. If you don't know how they're actually preparing that financial information, you could be missing something. You could assume a way, but that way that they're doing it, but that if it's not, then your analysis would be could point you in the wrong direction. And it's easy for me. Usually there's always room to move the accounting, but and it's also it could be an indicator of good management. So if you see a management team that chooses conservative accounting practices, that's a good thing, right? Like it's a good thing. You want to see that, and if you don't, then okay, like if it doesn't, but it sort of stands out. But when you see the guys that are doing the aggressive stuff, that's when you gotta go, okay, you gotta pause on that, right? But if you see any of the businesses you're looking at using conservative accounting, it's actually put a nice tick in the management box there. It's not the only thing you worry about, but it means that that's a good thing for you as an investor. Okay, so they state that gift card breakage, which is essentially people buying gift cards and not using them, are immaterial. Fine. So they do have gift card revenue. The breakage is immaterial, but it doesn't say how much the gift card revenue is. If it's material or not, presumably it might be material. It's good. People buying gift cards to your restaurant, that's a good thing. Company would capitalize these fees upon receipt from the franchisee and then amortize these fees over the contract. Okay. We have not received material development or franchise fees in the years presented and the primary performance obligation. Right. Okay. So when you see things getting capitalized, obviously that should perk your ears up as an investor. Because if they're moving things between the balance sheet and the income statement, there's more control over how the income statement looks. But in this case, they're saying that they have not received material development for franchise fees in the current period, so it's not really that material, not meaningful. Stock-based compensation. Company shareholder approved proposal to increase the number of shares available for issuance in the plan from 900,000 to 1 million. Net income includes 100 grand of stock-based comp, 200 grand. As a general rule, we don't like stock-based comp. And we particularly don't like stock-based comp when it comes in small companies. We don't think it's the best way to incentivize people, and frankly, there's different ways you can do it. And I mean, these options are underwater. Basically, all of them, except for these guys. So number two, people get their options, stock price tanks, now they feel bad about getting their compensation versus feeling good. And if the stock price goes up, now investors feel bad because you paid potentially too much to the employees and you're getting diluted. So yeah, stock-based comp is just, generally speaking, not and it can be an element of conversation, but we think pay people in cash and then encourage them to buy the stock. Like rather than putting stock-based comp, pay them cash and then encourage them either by helping them get, borrow money and pay those to buy shares and pay that down or whatever. But we think it would be better if you encouraged employees to purchase stock in the company versus just giving them options. When you spend the cash, studies have shown that we've seen employees actually feel more, they value the stock more, they value the company more than its options. In one case, they've spent money to acquire something. In the other case, they were giving something. And whenever you spend money to get something versus being given it, you value it more. Just the way people work. SVP Finance. Yeah. RSUs. Yeah, like a company this small, this is unnecessary. Just pay cash. Just unnecessary complexity in your compensation structure. Yeah, and they're all underwater. Or it looks like they're underwater. Gain and sale of assets and lease termination. For the 3 fiscal quarter, the company recognized $76,000. This is in dollars, keep in mind the size of deferred gains on prior sale leaseback transactions related to certain Good Times restaurants and $44,000 net loss on disposal of miscellaneous assets. So they got a gain, deferred gain on sale leaseback. So they sold the building and leased back the restaurant. They sold something and leased it back, doesn't mean it's the actual building. And they have deferred gain. They recognized a $640,000 gain in connection with the landlord's exercising a lease termination option for one Good Times restaurant, and we also recognized $700,000 in deferred gain on prior leaseback. So the first 3 quarters, they recognized a $642,000 gain in connection with the landlord's exercising a lease termination option for one Good Times restaurant. 600 grand. That's in 2022. So why do you having a gain? I guess because it gets written off on the balance sheet. It's a right of use asset. That's such crazy, just crazy accounting around leases. Landlord cancels your lease, you get a gain you got a gain. You made money because your restaurant got shut down. It's literally the craziest. Like, think how crazy that is. Like, as an account, like for the accounting. Think about that. The landlord terminates your lease. No more restaurant. $640,000 income in your financial statements. Bizarre. Bizarre. Straight line rent, most likely. Or maybe, yeah, basically if you deferred. Anyway, okay. We'd have to we have to think through exactly what that accounting is for, but just to be curious, but it's insane. That's crazy. Totally crazy. Prepaid expenses, prepaid rent, prepaid insurance, fine. Other accrued liabilities, wages, taxes, gift card. Okay. So they actually sell, quite a bit of gift card. $1 million, $1.2 million. But 1%? About 1%. That's a liability. It could have been built up over multiple years, but you know. No payable line. Let's look at the debt. Okay, so they have $8 million in credit facility. Okay, so they can use the funds for new restaurant development, finance the buyout of non-controlling restaurant partners, finance redemption, purchase, or other acquisition of equity interests for capital purposes. Okay. If you borrow half, you have to have a specified leverage ratio you got to meet, so there's more covenants that kick in. The interest that would have been applied is 8%, so they borrowed 8% if they draw on this thing. Okay. Okay, here we go. Another risk. The company is a defendant in a lawsuit styled as White Winston Select Asset Funds, LLC, and GT Acquisition Group, Inc. versus Good Times Restaurant, Inc., arising from the failed negotiations between the plaintiffs and the company for the sale of the Good Times drive-through subsidiary to plaintiffs. So this failed to for the sale from failed negotiations between the two parties for the sale. Who was the buyer? The lawsuit was filed. Who was selling to who? The lawsuit was filed on September 2019 in Delaware Chancery Court and removed the case to federal court. Blah blah blah. And the plaintiffs moved the court for leave to amend the complaint, add new clause of action, and claim $18 million in damages on September. The court heard parties' motions for summary judgment of the plaintiff's claims. The court verbally ruled that it was dismissing all of the plaintiff's claims except for the clear claim of breach of an express and implied obligation to negotiate in good faith under the parties' letter of intent. In good faith, the court also indicated its intent to dismiss Good Times' counterclaim against the plaintiff for breach of a code not to sue over the failed negotiations. Interesting. On May 5th, they issued a written order confirming this ruling. On May 25th, 2020, they issued an order that plaintiffs are only entitled to reliance damages should they prevail on their claim for breaches of the express and implied obligation to negotiate in good faith. Parties conducted a bench trial on the plaintiff's claim. Parties concluded post-trial briefing on January 25th, 2023. The court rendered judgment dismissing the plaintiff's claims in their entirety and denying all the requests for relief. Plaintiffs filed notice of appeal. Filed notice of appeal. The court's previous dismissal of the counterclaim. Parties are now conducting appellate briefing. May filed their opening brief. On June, filed its brief. Okay, response. Yeah, defense counterclaim. The Case deadline for the reply brief in support of the is August 22nd. Good times deadline to file. Okay. After that brief, closing the Court of Appeals may render decision at any time. Okay. Previous recorded accrual amount of 332,000. This amount represented the company's best estimate of the amount of claims Dignity was recovery. While the company's successful trial in light of the available appeal, the company has decided to maintain the accrual and will continue to evaluate this matter based on any information that becomes available. The ultimate resolution can result in losses less than or in excess of amounts accrued. Additional liability in excess of the accrued material. Okay. There's also legal fees. So let's see if we can find the court documents. Documents. District of Delaware. Okay. District of Delaware .gov. 525. Here we go. Memorandum of opinion. This was May 25th. So it's a little bit old, but we're going to see something. We're going to check it out. So this is many agreements to negotiate good faith. It's just less risky, but good faith provisions not bind the parties to reach a final deal. So when one party breaches, usually the other can recover only the money lost relying on a promise to negotiate, unless the preliminary agreement also binds the parties to some terms of the final deal. He cannot recover the amount he would have made had the deal gone through. So basically, you promise to negotiate, not to make a deal. Okay? To negotiate. There we go. White Winston bartered with Good Times to buy his chain of burger joints. Drive-through. Interesting. So it looks like it wasn't sale for a single one. He was trying to buy all of them. These discussions, the parties signed a preliminary letter of intent committing to a deal exclusivity with each other in good faith. But just as the parties were to sign a final contract, Good Times tanked the sale by raising its price. Okay, so kind of sounds like an 11th hour kind of negotiating tactics. So now, was Good Times price demand a bad faith tactic of the sort barred by the letter? Fair enough. Expectation damage around 18 million. So this guy was expecting to make $18 million. So had the deal gone through, expectations was that this White Winston would have made $18 million. That's for the Good Times franchise. Remember, Good Times is the smaller part of the chain. So this guy, and now it's obviously this guy's trying to make his claim look bigger. But his implication of this is that the smaller chain is worth $18 million. If the smaller chain is worth 18 million, this is a year ago. Obviously, times have changed. The smaller chain is worth 18 million. And by smaller, for scale, the Good Times franchise is 23 stores. Bad Daddy's Burger Bar is 39 stores. And our understanding is that 75% of sales is Bad Daddy's. Yeah. So Revenues, this is 2022, full year. Okay, sorry. Yeah, 34 on 138. Right? Is that about 25%? Yep, 25%. So 25% of the business is good times. According to this, the suggestion is that 25% of the business is worth $18 million. $18 million. If that's true, not to say it is, the entire company is worth $72 million, all else being equal, which is a double, which is significant. Now, keep in mind, this is a lawsuit. Expectation damages are what they are. It's this guy's expectation of how much money he would have made, which he's trying to make look bigger, most likely. So, da, da, da. Okay, so these are all precedent cases. It's all legalese. All right, let's see if we can find. So this was a year ago. Let's see if we can find more recent evidence from the case. This is Jan 2020, Jan 25, 2023. Procedural history. Here we go. This is January 20. This is from January 25th, 2023. So it's later than the. Here we go. In the summer of 2018, Good Times decided to sell drive-through, which is the smaller chain, the burger chain, right? Right, Bad Daddy's, Good Times Burger, it's drive-through. Okay. Hoped the chain would fetch 12 to 15 million. 12 to 15 million dollars. Lark Burger. Okay, whatever. January 18, 2019, submitted a letter of intent to buy it for 9.5 million. Okay. Yeah. If it's 9.5 million, that still only puts the value of the, if you apply the same multiple, which is not necessarily the case. But 10 million bucks, I mean, you're only paying 20 million for the rest, which is $75 million in sales. Okay, so sales were declining at that time. Okay. So this puts into context. Remember the franchise Good Times Burger. So the Good Times franchise has declining franchises. 2012, 15, 2018, sorry, 2023 had 8, and it's been pretty steady at 8 since 2019. So they have 8 franchisees, but they've also essentially closed about 5 stores since 2018. They've bought them back. So I guess between franchises and owned stores, company had 39 in 2012, and now they have 31. So a total closure of 8 over the last, whatever it is, 10 or 12 years. So the Good Times, so they've been shrinking the Good Times franchise, which is, fine. That's that's the sort of the quote unquote McDonald's competitor, which is not really McDonald's competitor, but it's the one that sells the $7 double cheeseburgers instead of the one McDonald's is selling for 4. So we're not shocked that this chain is not, growing rapidly and is actually shrinking. Working capital deficit is 150,000. So amend the letter of intent. Yeah, so they tried to get rid of it in 2019, 2018. It's all just procedural, like this is basically just backstory, which is good. This is good because it does give this kind of stuff gives really good insight into kind of the parties and what management does in a sticky situation, how the board reacts, so on and so forth. It's 9th. So the drive-through sales were up. The board backed away, so the board kind of started to see some life in the business. They said, well, Try to raise the price on the guy. Conclusion of the loss is all the legal, how the judge is interpreting the situation. Okay, that was really good. So I think we need to then let's take a closer look at just the top line sales by brand. So over time. See what we can see. Just see by brand. So it looks like back in 2018, 2019, we want to sell the Good Times, uh, the Good Times business, namesake, Bad Daddies, just the actual line, because Good Times is shrinking against the but McDonald's of the world, even though they're fast casual, but if you want to just look at burger, getting against the McDonald's of the world, at literally twice the price. And customers are, if you have a better quality product, okay, customers are willing to pay attention. But if you're spending, if they have to spend twice as much to eat at your restaurant, that's effectively the same. Like it's still a double cheeseburger. They just go no. Breakdown, segment reporting. Segment. Good times. Good times. Okay. Why didn't we do segment reporting earlier? Again, we try to, as much as possible, minimize, start high level there, but you sort of find stuff, you kind of keep going. You're looking for deal killers, because there's so many things that can kill a reason why you would invest in a company. You're kind of looking for that, because if you can't find them, they're not really big. It's nothing really that's material, and you got a good reason. Uh, a pretty good reason to keep going. Yeah, this is this is kind of when they started it, but soon sales back in 2012, 2013 is no, we're not going to assume it is. It's all just good times. Okay. Okay. Right. So I think you can kind of get a flavor for the process, right? Like you start with you're basically trying to work as a detective. You start with questions. This, what about that? Then you start to find evidence to deal with those, right? Um, all that kind of reading just came out of a note that said that they got sued, and there's more context. So you can actually see, like in here, they don't tell you the amounts, and you have to go to the actual documentation and say, okay, they were trying to sell it for $10 million, $11 million. So they're saying, okay, good times back then, $11 million, 2018, 2019, when they're doing $30 million sales. Now it's more, sales are higher, arguably. So yeah, so when we look at segmented reporting, sales, so again, the lawsuit, when do they actually initiate term discussions? Here we go. It was 11 million. 11 million. So August 9th, I believe it's in 19. August 8th, August 6th, August 2nd. Yeah, on July, so in 2019, so August 9th, 2019, they tried to sell it for $11 million and it killed the deal. In 2019, the company's doing $30 million in sales. The potential buyer, I think initially in 2018, offered 9.5. So this guy at this time was willing to do 9.5, about 10 million bucks. Yeah, January 2019, 9.5 million. Right. So the company's doing about $31 million at a time. Potential buyer 9.5. They raised to 11, killed the deal. So let's call it 10. Let's say that maybe the guy would have went to 10. Sales for that brand are now $35 million in TTM. In 2022, they were 35 million. Right? Whereas, there you go, about 35 million. So sales have increased relative to by 12% gross, 13% gross, relative to 2018, 2019. Suggesting that at the very least, a rational buyer, a reasonable buyer, might be willing to pay at least $10 million, right? Maybe more because sales are up, but at least 10 million because you had some guy back then. Now, it wasn't a flood of interest, but he definitely had interest. Okay. So 10 million bucks. If we assume, okay, so you have one data point. Now, it's one data point. So you say the good times sale value. Multiples have changed, lots of stuff have changed. Financing has changed, financing rates have changed, all kinds of stuff have changed. So there's nothing to suggest that you get the same thing automatically. But because sales are higher, there might be some offsetting factors. $10 million doesn't sound so crazy. Doesn't sound so crazy. The income Good times obviously is way down, right? 2021. This is from operations, so you know, basically here's 3.6 million here. So 10% here it's nothing. It's unclear what's driving this though, right? They had a lot of wonky stuff like impairments and all this kind of junk going through the income statement. Here, $3 million in 2020 and $1 million in 2019 and 2018. Right, so the guy was willing to pay pre-tax 9.5. You know, he's willing to pay 13 times pre-tax, which sounds like a lot, but obviously he was expecting, seeing something go like this, which is much more palatable, obviously. All right. So now sales have tanked. Now profits have tanked again. The question is, what is the our profits looking? So profits in the year for good times, 1.6 million. So despite it being smaller, it is a more profitable portion of the chain, at least currently. Once you got to strip out all the sort of this income from operations. Remember, they got all this like income statement impairments and whatnot, right? Yeah, $1 million impairment and all this kind of stuff. That's just extra. But doing did 1.6 year to date. So 1.6. So it's doing 2 million. Revenue's higher. Maybe strip out some of the impairments. Some of the wonky stuff. Yeah. So you get more revenue. Profits are down. Could you get 10 million again? Good question. It's a good question. Hard to say. Financing rates are higher. 6% pre-tax margins. It's 2.2 million. Say you get 4 times 8.5. Okay. Let's assume $8 to $9 million is not crazy for the good times. For good times. Let's assume 8 to 9 million is not crazy. Which means, again, this is like gross back of the napkin just to get a flavor of, So let's say somewhere around 23 million, 22 million for the entire Bad Daddy's franchise. 22 million. For the entire Bad Daddy's chain. Somehow that feels really cheap. Because you're making $100 million in sales. You're selling $100 million worth of food. $22 million buyout price. $100 million. Average, it's over 40 stores. 104 million. Average store is doing $2.6 million in revenue. If you can even get a 6% margin on that, pre-tax. $6 million bucks. $25 million. Maybe not so crazy. Really depends on what that margin is. Maybe the current value is not so, current valuation is not so local. Because, okay, so if we say the Good Times franchise could reasonably go for $8 or $9 million, say $9 million. Question is, what makes this Bad Daddy's worth more? Okay, so that's the question. So if you can say Good Times is worth $9 million, and the whole company's trading for $31 million. So what are your assets in place? You got 31 million, take off 9 for your Good Times, $72 million valuation. Now there's cash in the books, but you know, assume that doesn't get, assume that you can factor that in, but it's 3-4 million. It's not really the thing you're looking for. So the question is, what makes this worth? What makes the Bad Daddy franchise worth 40 million? Right? That's what it boils down to. It would have to be worth $40 to $50 million to make, like, legitimately to make this a sensible investment. You want it to be ideally more. So for it to be worth $40, $50 million, margins would have to be in the 10% range, which does not seem likely, or at least not. Yeah. Now it's been growing. What does a good year do? Yeah. Yeah. They get killed. Oh yeah, there's another thing too. In the pandemic, the Bad Daddy's chain actually shrank in sales while the Good Times chain grew. Sales shrank by in the pandemic. Sorry. Sales shrank by about 4.5%, which is kind of what's already happened. But profits tanked about 14 million. But oh wait a minute, hold on. There's some allocation of stuff in there. Yeah, this Google impairment stuff is probably what's killing it. It's probably what's killing it. Income from operations, yeah, they had to allocate it somewhere. So this is probably smashing that that line item. Well, what were the operating costs? So 12 million before G&A and advertising, after G&A advertising. Because someone has to run the business and advertise for it. Yeah. That's the pandemic though. Yeah. All right. I think I might be moving on, gentlemen and ladies. I think we are at our limit for this company. Yeah. Yep. I think we're done here. Okay, so what is the conclusion? What do we learn? Well, the one business, the smaller restaurant chain, has been able to grow. Actually, that's the only one. That's the one that's consistently grown sales, even during the pandemic. The other chain has also grown, but they've increased store count. In the pandemic, they declined pretty heavily. But since then, sales have ramped up. In the meantime, customers have shifted to the cheaper option, which we saw as on the same store sales side. So you saw that here, right? Sales are up in the quarter. Sales are up for the year 3.7%, and they're basically flat. In the quarter, sales are up for the quick service restaurant, down for the sit down restaurant, right? And in the pandemic, sales for this brand also decreased by 5%. So you've gotten sort of pandemic era sales decline so far. Nothing to suggest that it can't go lower, of course. So what does that mean? It feels like there's a good regional. It feels like it's a good regional chain. It looks to be the brands are good, but it's a high price, like the high price point, right? Customers might like the food, but it's still a high price point, so they have to switch, shift their consumption patterns during leaner times. Thanks to the lawsuit, we saw that at least there's one data point where for the given level of revenue profitability, there's one buyer willing to pay around $9 or $10 million. Revenue has grown since then, even though profits are down a little bit. So if you assume that there's those are offsetting forces to a certain extent because inflation will moderate at some point. Then you could say, okay, well, the one chain is worth about 9, maybe 10 million. Let's say 9. And that means that the other chain, the big one, which is doing about $100 million in sales, is selling for around 22 million in market cap. They have about $3 million in cash on the books, and we'll see what that looks like at the next quarter because they usually run a little bit higher than that. But when they release the full year, we'll see what the balance sheet looks like. Could be higher. That might help the results. But in general, when you're looking at something like this, you need a double, at least a double, and a safe double. Otherwise, why are you doing it? So what would make this a double? To make this a double, you basically need the bigger chain to do, $8 million to $10 million pre-tax, something along those lines. Would be a safe double, right? And if it's 8 million, I'm talking 7% margin, 10 million, obviously, you're doing about a 9% margin. So you need the Bad Daddy's restaurant to do about 9.5 to 7.5 to 9% income from operations, pre-tax margins, pre-tax margins on that business. That would produce about $8 or $9 million in pre-tax income, and you cap that at 4 or 5 times, and you got your about $40-50 million in value to the equity. There's no real meaningful debt either. So that would be what you would need. That being said, so far profits have not shown through like that. Profitability has actually been spotty. Free cash flow, overall, it's around $4 million. So it's even on the free cash basis, you're running about half that. You're running about half that on a free cash basis, right? If you're going to sell that chain, if you're going to claim that as the asset, then you need a lot more cash coming out of this thing. You need a lot more cash coming out of this thing to even consider the going in. But you're also facing this headwind, right? So the headwind is you are a premium price product staring down, eyeing down the storm of a potential, at least consumer slowdown, which is already happening, if not a 2024 possible recession, right? That's kind of what you're facing down as an investor. So the question is, what is there are the results so compelling, or is the potential so compelling that you'd want to step in front of that? We think the answer would be no. Doesn't look that way. Doesn't look that way. Looks like it's a nice burger chain. Premium price. Does well when times are good. It's going to take a hit when times are not so good, but good regional chain. If you're in Colorado, customers are probably going to know it well. If you're in Denver, or around Colorado, but what's the company has stopped expanding in terms of number of stores, right? So store count is flatlined since 2021, and doesn't look like that's changing anytime soon. So if you can't add more stores, and you're facing down this consumer recession or consumer slowdown at the very least, and profits on the current business are not worth it, then it's not a turnaround, but it's an operating. You'd have to assume operating efficiency play. You'd have to assume that management is gonna has been investing heavily in growth versus just keep the business growing, and that somehow they're gonna change that model, and sales will continue and profits will appear. And apart from, and you'd back out obviously all these impairments and all this kind of stuff. So we just don't think, it doesn't seem like that. That's not a fantastic scenario to jump into, right? You're not like, for lack of a better word, you're working too hard for it. You're working too hard for it. That's what it comes down to. Okay, so you're working too hard for it. All right, that was fun. Learned a lot. A lot. Yeah. Like, yeah, that was really cool. That was fun. Okay. Okay. Well, next. All right. What do we have next on the list? So right now we gotta pick up where we left off from our list. Bear with us for a second as we try to read ourselves. Oh. Work. Castor Maritime. What is Castor Maritime? $15 ago. What? Castor Maritime announced the sale of the MV Magic Sun and MV Magic Phoenix for an aggregate $20.55 million. A diversified global shipping company announced that on October 8th, okay, the company entered two separate agreements with two affiliate parties for the sale so they're selling boats. Panamax bulk carrier for a price of $6.5 million, and this one for $14 million. Gain of $1 million, excluding any transaction costs, and a loss of $2.6 million from the sale. They own 20 vessels. Kamsar Max, 11 Panamax dry bulkers, Okay. What are they going to do with the money? And bid price requirements to regain compliance with dollar bid requirements. So something's wrong here. Something seems to be very wrong here. $15 million. So, okay, it's a shipping company, clearly. Balance sheet. Are they just loaded with debt? We got a lot of debt. Yeah, got a lot of debt. Okay. We don't know what the problem is, but we don't really know shipping, so. Or at least don't know any of this. Shipping has a lot of hair on it typically. Something happened. Be a net asset play. Nah. No. Looks like there's a lot of hair. Ah, we gotta take a look. All right. Castor Maritime. Already written about it. Notes. July 6th. Okay. So it looks like potential dilution. They bought into Eagle Bulk Shipping. They acquired Oak Tree stake in Eagle Bulk Shipping. Eagles, they bought back the Oak Tree stake. Wow. So according to this report, they have a stake in Eagle Bulk Shipping. Castor Maritime. Their website is undergoing maintenance. That's never a good sign. Okay. All right, we're just gonna skip it. We don't know, and it's not worth or at least business we don't really know well. Restaurant, Dallas. Pizza buffet, delivery, carryout. Pizza Inn and Pie 5 trademarks. Pizza Inn franchising. I think we looked at these guys in the past, and we didn't like them for some reason. We did not appreciate them. We don't think. What's it selling for? $34 million. Yeah. Pizza. Here we go. Pizza Inn's owners entangled in legal battle with its former CEO. Scott Crane is suing the operator for breach of contract, saying he's promised 100,000 stock he never received. Suing the operator, saying he promised 100,000 shares, was fired without cause. Scott Crane. 2017, 4 Fast casual Pi 5. Crane was the former CEO of Smashburger. Okay. Pizza Inn issues bizarre statement in support of Trump's bogus voter fraud claim. January, what? Okay. All right, so there's some stuff going on. Is there any reason why this is worth $70 million? 2021 annual report is the most recent filing. Really? Well, that's not good. SEC filings. 10Q. Three months ended. September's annual. Okay, so most recent annual is here. Okay. It's a franchising business, so the economics are a little bit different. Bought back a heck of a lot of stock though last year. $5 million, $6 million in cash. Basically no debt. Half that line, okay. June, 152 franchise pizza restaurants. Pizza Inn, 2755. So pizza franchises. Some of which are international. 34. Sales, 120 million total. For, this year, 120 million. And they pulled in how much? Oh my goodness. Yeah. small pizza franchise that is, 20 times. We don't know why we would ever. Yeah, skip. Express. Who are these guys? Inducement grant. Or so what do they do? Consumer cyclical apparel retail. Columbus. The fashion retail company that offers apparel, accessories in the United States and Puerto Rico. Okay. Up West and Express Brands. Okay. Sales are declining. Not a good sign. Profits are all over the place, so there's probably some wonky stuff happening. Quite a bit of debt. Okay. Express Inc. Investor Relations. Where is the most recent annual report? Please. Annual filings. There we go. Okay. Florida, Illinois. Okay, so they have 550 stores. Looks like some in South America, but not much. 1,000 associates. How much is this thing selling for? $34 million. You employ 11,000 people. Results. Critical automatic store asset impairment. Long-lived assets would include property of net of 300 and consolidated right of use asset net of 505 million, which is a significant portion of such balance is really strong. Okay. So when auditors called stuff basically saying that are the stores worth what they're on the books for, or what the assets of the stores on the books for, usually means that there's a problem. But they're not willing to. The auditors will conclude there's a problem after the problem has happened, not before. It's still a customer. Whoa. Yeah. Equity method investment, 166 million. Billion eight in sales. Wow. Well, what's the wrong with this company? Obviously, something is wrong. Last year's down 70%. Ah, retailer continues to implode. Let's look at the quarter. So, transaction gain. That's what it was. Still losing money. Yeah. Yeah. Losing big time. Sales are going down. Can't compensate. Minimum royalty payments reflect the annual minimum. They have minimum royalty payments. All right. We are going to pass. This is the last one. Direct digital. What do you do? Advertising agencies. Present end-to-end full-service programmatic advertising platform. Company's platform primarily focused on providing advertising technology, data-driven campaign optimization, other solutions to underserved and less efficient markets on both the buy and sell side. Profile. Wow. Now that's a growth trajectory. $6 million in 2019 and $100 million year to date for TTM. Wow. How did they achieve that? Okay. How did you expand your business by 20 times in 3 years, 4 years, whatever it is? In 2020, we record Orange 142 to post. Okay. Buy side advertising platform. So they bought something. Okay. Looks like a roll up of some kind. A lot of terms, data lakes, whatever. Verizon Media. Digital advertising is what it looks like. What makes these guys special? Hmm. Section 13D. contingent loss on early termination of line of credit, interest expense. So they're paying a lot of interest cost. $2 million, which is basically all of their profit. And they're, yeah. $1 million a quarter. $1 million a quarter. How much did they make last year? $4 million. So it's all going interest cost. So why would we do this? Looks like some kind of media roll up story. Go for these. Okay, well, I think we're gonna cut it here. That was a good look overall, but I think we're gonna get just pass for today, and we'll see you next time.